So the next kind of trading bot we'll discuss and trading strategy we'll talk about is arbitrage. So arbitrage refers to the difference in price of any asset between markets or exchanges. Now, this could include stocks, commodities, currencies, and cryptos, right? It doesn't necessarily is not necessarily pertain to just one of these assets. It's just the idea of making a profit on the price difference between two different markets or two different exchanges. So, for example, let's say Bitcoin may be trading at $42,174 on Coinbase, and it's trading at $42,324 on KuCoin and $42,095 on Binance. Now, each of these exchanges act as their own market, where price is dictated by buyers and sellers on the exchange. There is no global agreed upon price that all the exchanges follow for Bitcoin or really for any asset. And this is where arbitrage situations come into play, where let's say someone sees this price on Binance and they see a higher price for the same asset on KuCoin. They could buy the asset on Binance and sell it on KuCoin, profiting off of that, let's say $200 give or take move, right? There's about a $230 difference between the price of Bitcoin on Binance and KuCoin. And this is where the strategy called arbitrage trading. They're buying that asset on one market, they're reselling it at another price. One could buy Bitcoin on Binance at $42,095, sell it on KuCoin at $42,324 per Bitcoin, making a $229 profit per coin. Now, you might think, oh, well, it's $229. They just did that in one purchase on one coin. Now, if you scale up this operation and let's say you're doing 5 Bitcoin at a time, now you're making over $1,000 on one arbitrage trade. If you do it with 10 Bitcoin at a time, you're starting to ramp up the amount of potential profit per coin. Now here we see, this is a listing. This is on CoinMarketCap. Here we see the various prices of Bitcoin on a variety of Bitcoin markets, and these are the names of the different exchanges and the trading pair. As we can see here, this is Bitcoin to the US dollar. The only difference we see here is on Kraken, which they label it as XBT, but it's basically Bitcoin. As we can see here, there are several price differences, right? So we could say the lowest one I see is on Binance US. Binance, we see the price of Bitcoin being $55,839. The highest we see is on FTX. FTX, Bitcoin is actually $55,967. So if we were to buy this Bitcoin on Binance for $55,839 and we sell it on FTX for $55,967, we're looking to make a little over $100 per coin, right? Which may not seem like a large amount, but if you're doing this near instantaneously with an automated program and you're moving multiple Bitcoin at a time, let's say 5 Bitcoin at a time, you're making over $500 in one quick transaction. Here's another example. These are the Bitcoin markets. This is the trading pair Bitcoin to US Tether, USDT. So slightly different prices. And this is where you can start to even consider swapping not only between exchanges, but also in between trading pairs. So let's say you bought Bitcoin on US dollar, as we see here, and the lowest price on US dollar was Binance at $55,839, and the highest price on USDT is actually $56,000.09. So the difference there would even be higher. So you're looking about at a $160 difference if you were trading between the Bitcoin to USD trading pair on Binance to the Bitcoin to US Tether on FTX. So that's an even larger spread there and more opportunity for more profit for an arbitrage trader. Now, arbitrage trading ensures that the prices of an asset on any exchange or any trading pair does not vary from fair value, quote unquote, for long periods of time. Now, any outliers are quickly acted upon, where traders buy that lower priced asset and they resell, often in a matter of seconds, right? So this is resulting in a sense of balance between the exchanges and markets, where price will not stray too far from fair value, otherwise traders will take advantage. If price is too low, too far away from fair value and is extremely low on one exchange, people will end up buying that, or bots will end up buying that, which will drive the price up on that one exchange. They'll move it over to the higher price exchange and they'll sell it on there, essentially driving the price on that higher price exchange. And this acts as a sense of balance, is a balancing effect. And this is what keeps the crypto markets and the crypto exchanges relatively around the same price, right? These arbitrage traders are essentially balancing things out and profiting off of that process of balancing out the price on different markets. Now, to take advantage of such situations, many traders have developed automated trading systems, or bots, to monitor fluctuations in an asset on a variety of exchanges. These bots constantly scan and buy, send, or sell the assets across markets to take advantage of the price differences almost instantaneously. And this is where it becomes much more difficult, and arbitrage trading is now a very hard market to get into, especially if you're not using automated systems, because the bots are able to scan for these fluctuations. They're able to calculate what is worth moving around, what's worth purchasing, where the prices are higher, where the prices are lower, near instantaneously, right? Much faster than what a human can do to process this information, right? Because first you have to find the lowest price asset, you have to find that same asset and find a trading pair or an exchange that's offering it for higher. You have to factor in the transaction fees and the exchange fees, the fee on the network to send it over to the exchange as well. These are all things that you have to consider. Bots are able to calculate this and figure out whether or not it's worth doing or not, much faster than a human would be able to. And they're able to execute it much faster. That means not only do you have to calculate all those things, you have to do it before other people doing it, because otherwise those same prices are not going to remain the same. Now, the most common form of arbitrage trading is exchange arbitrage. This is where a trader buys the same crypto asset on one exchange and sells it on another for a higher price. Consider, though, that the prices of crypto can change very quickly. Looking at the order books for the same asset on different exchanges, you'll see that prices are never exactly the same at the same exact time, right? They're constantly changing, they're constantly fluctuating. Arbitrage traders exploit these small variations in price for profit. This in turn balances out the overall market, as prices tend to stay in a relatively contained range on a variety of trading exchanges, right? We know that if we look at the major exchanges, let's say Binance, Coinbase, and others, the price of Bitcoin is relatively the same. These arbitrage traders, they're looking for these outliers, these opportunities, and they're capitalizing them. And not only are they doing this, they're actually competing with one another to be the first to do it, because once people have started doing it, the opportunity is not there. Here's a visualization of this process. So let's say there's this person, they're buying on exchange 1, they want to sell it on exchange 2 for a higher price, and then they profit off of that exchange. They profit off of this process. And this could be a small amount of profit per coin, but if you're buying 10, 15, 20 Bitcoin at a time you're doing this with, which is hundreds of thousands of dollars at today's current prices, you are profiting tremendously off each one of these moves. So another type of arbitrage is funding rate arbitrage. This involves trading for crypto derivatives. It's when a trader buys a cryptocurrency and they hedge against its price movement with a futures contract of the same crypto with a funding rate lower than the cost of purchasing that actual crypto. In case you're not familiar with derivatives, please see our lesson on derivatives and futures trading. That way, that'll be much more focused on the explanations behind it and the reasoning and how that whole system works. Now, the costs in this situation are any fees that opening and maintaining the position may occur. Right, we have to pay our margin calls, if there are any, and our overall payments for having the position open over time. Now, an example of this could be where you own some Bitcoin, so you hedge against your Bitcoin by selling a futures contract. You're shorting Bitcoin for the same value of your Bitcoin investment. Now, if the funding rate of the contract is positive, that means that people are thinking Bitcoin's going to go up. There's more people longing the market. Then, as a result, buyers, people who are longing, have to pay shorts for the contract. Remember, every time that there is a derivatives or a futures contract, you are betting on the futures price, on the future price of the asset, and you're creating a contract that you are going to buy, right? If you're longing, you are signing a contract that says, I'm going to buy at this price, right? Now, if you're shorting, you are saying, I'm going to sell. You are agreeing to sell at that certain price. So there's always somebody on either side of the fence when you're longing or shorting to act as an incentive to have enough people shorting when the market's moving up. If there's too many people longing, then the funding rate will be positive, and that's an indication. And as a result, the longs, people who are buying, will have to pay the shorts for the contract, and especially for holding the contract and keeping it open. Now, if the funding rate is 2%, then you can get 2% for owning that Bitcoin without any price risk. You already own Bitcoin. The price of Bitcoin is going up, so the price of your owned assets are going up. At the same time, you open up a short position. That is a bit of protection just in case price decides to retrace and go down. Maybe even if you do hold the Bitcoin that you're holding, right, you are profiting off of Bitcoin's price fluctuation because you still have that short contract, right? If the price of Bitcoin goes down, you are profiting off of it. Here's just a visualization of funding rate arbitrage. So let's say the index price, the price of the asset is down, but the futures price is up. This is the indication that more traders are holding the long position, and funding rate payment from long position to short position. Now, if the index price is higher than the futures price, this is an indication that more traders hold the short position. More people are shorting the market. Funding rate is negative. The funding rate is paid from the short positions to the long positions at this particular moment.